This video is an Uncover Japan Company research report on Santec Holdings, ticker 6777. It is an independent Japanese photonics specialist whose tunable lasers, optical components, and measurement instruments serve AI data networks, semiconductor production, eye care, and quantum research. The company has a genuinely unusual operating record, but its share price also requires an unusually careful reading. The snapshot is clear. In the year ended March 2026, Santec earned a 32.8% operating margin and a 31.1% return on equity. Revenue has compounded at 37% over 5 years, but the shares traded on 34.4 times forward earnings as of the report date. This is not a cheap quality story. It is a high expectation story. What does Santec actually sell? Its core platform includes external cavity tunable lasers, LCOS spatial light modulators, optical coherence tomography, optical thin films, and MEMS. Those capabilities are deployed into 4 markets: optical communications, semiconductor and industrial inspection, ophthalmic instruments, and quantum research. The visual here shows the practical breadth: fiber optics, a measurement instrument, a light control device, and ophthalmic equipment. The common customer is technical, and decisions are made on accuracy, reliability, and support, rather than the lowest price. The segment structure matters because it is not a balanced 3-way portfolio. Optical measurement represented 71% of FY26 sales and delivered a 36.9% segment margin. It includes telecom test instruments benefiting from North American data center construction, industrial instruments exposed to semiconductor capex, medical instruments supplied through Alcon, and quantum products acquired with MOG Laboratories. Optical components is smaller, but also highly profitable, while solutions is an emerging lower-margin third leg. The financial record is exceptional. From FY22 to FY26, revenue rose from 88.9 billion yen to 315.1 billion yen, while operating profit increased from 16.3 billion to 103.3 billion. That makes the profit growth faster than sales growth, which is exactly what the margin story implies. Management's FY27 guide calls for 370 billion yen of revenue and 120 billion yen of operating profit, though investors should remember that Santec has historically begun with conservative guidance. Profit is supported by real cash conversion. Operating cash flow reached 81 billion yen in FY26, while free cash flow was 41.5 billion yen. Over the same 5-year period, gross margin rose from 48.8% to 57.7%, and the operating margin from 18.3% to 32.8%. The balance sheet is effectively debt-free. The important question is not whether this has been a strong financial model, it is whether telecom-related mix and capacity expansion can preserve these economics. Geographically, Santec is genuinely international. 78% of FY26 sales came from outside Japan, with the United States now its largest market at 33%. But diversification by geography should not be confused with diversification by customer. Alcon, the ophthalmic device company that buys the Argos measurement engine, accounted for 5.6 billion yen, or 17.7% of sales. That relationship supplies stability, but it is also a single customer risk worth monitoring. The core moat is not scale. It is accumulated precision photonics know-how, including a tunable laser lineage that began with a commercial world first in 1987 and has reached its 7th generation. Santec keeps the high-value design, calibration, and verification work in-house, while using its Vietnam operation for assembly. The same platform is then redeployed across end markets that do not move in lockstep. That creates resilience, but the platform still needs to renew with each technology transition. Management's growth algorithm is to extend the platform into new niches faster than any one niche matures. The near-term vectors include higher-speed 800G and 1.6T optics, co-packaged optics, multi-core fiber measurement, quantum photonics, and next-generation medical devices. Capacity is also a live constraint, with expansion in Vietnam and Ottawa intended to raise the supply ceiling. This is self-funded growth, supported by cash generation and a history of targeted technology acquisitions. Valuation is where the debate becomes difficult. Santec's forward PE rose from roughly 9 to 16 times in FY22 through FY25 to 34.4 times at the report date, around twice its 5-year average of 14.4 times. Relative to Japanese optics and AI infrastructure peers, that multiple was mid to low, despite its high margin and growth. But relative cheapness inside an expensive sector is not the same as an ample margin of safety. The report's illustrative scenarios make the asymmetry visible. The 3-year bear case is 7,900 yen, assuming an AI capex correction and a stronger yen. The base case is 18,900 yen, based on mid-teens growth and a 20 times earnings multiple. The bull case is 35,000 yen, requiring continued AI strength, plus contribution from newer technologies. These are not price targets or recommendations. They are a compact way to show that the current share price already sits above the stated base case. To conclude, Santec is a rare, independent photonics platform with high margins, strong cash generation, and credible growth options across networking, medical, and quantum applications. The key risks are just as concrete: AI capex cyclicality, customer concentration, FX, technology shifts such as co-packaged optics, and a valuation that prices in substantial continued execution. This is educational research, not investment advice. Use the linked deep dive to examine the evidence and form your own view. For a much deeper look, visit the free deep dives at uncoverjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security.